a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about defined outcome or buffer ETFs. So these ETFs, this is one of the fastest growing segment in the ETF market, and particularly last year when the market was very volatile and all major asset classes had negative returns. This category gained a lot of assets, and they do what they are designed to do. Basically, they allow investors to participate in the market upside up to a cap while limiting the losses if the market falls. So Innovator was the first provider to launch these ETFs, and they launched in August 2018. Before that, these kind of products were available in the form of structured notes or certain insurance products, but not in the ETF form. So the advantage with ETFs is that these ETFs are much more liquid and generally cheaper, and also there is no minimum investment requirement or counterparty credit risk. So ETFs are much more convenient for investors. And now there are over 160 ETFs available to investors with over 23 billion in assets under management. And recently, BlackRock also joined this party of buffer ETFs, and they filed for 2 ETFs. And with BlackRock joining this fast-growing segment, we believe that expense ratios will come down further. Currently, these ETFs charge around 70 to 80 basis points. These are not cheap, but they do what they are supposed to do. How these ETFs work? So this is what investors should know and understand before they decide to buy these ETFs. So there is a defined index. So generally S&P 500 index, but there are many other buffer ETFs that are designed to track other indexes. Then there is a defined cap and also a defined buffer. So the cap could be 10%, for example, the buffer could be 9%, 15%, 30%. And then there is a defined outcome period, generally 12 months. So these ETFs are designed to achieve those outcomes over that outcome period. Now we'll discuss a little bit more by giving an example, but let's further see what exactly these ETFs do and what they hold, how they work. So these ETFs would hold a basket of what is called flex or also flexible exchange options. Now we know that options are products that give buyer a right but not the obligation to buy or sell a certain security. These flex options allow investors to customize contract terms. Now what happens is that in this strategy, the provider would buy put options. These put options will give it the right to sell its exposure if the index falls, means declines in value. So that strategy limits the downside risk. But this strategy is costly. So to limit costs, this strategy is funded by selling call options. So call options would give the purchaser of the call option, your counterparty, would have the right to buy the exposure from you at the strike price, but that is going to limit your upside returns. Then there is another put option which is sold and which has a strike price lower than the put that you purchased. So, which means that investors are exposed to losses that exceed that particular defined buffer. So, again, these are designed to protect investors from a certain level of losses. Now, let's take an example how exactly these ETFs work. So let's take an example so you can understand how these ETFs work. So for example, our buffer ETF is based on the S&P 500 index, has a cap of 15% and a buffer of 10%, and the outcome period is 12 months. So it could be from 1st of January this year to 1st of January 2024. So this outcome would be over this period. Now, investors can buy and sell whenever they want, but these would be designed to achieve these caps and buffer during only this outcome period. So if the S&P 500 gains below 15%, your cap is 15%. If the gains are, say, 13% or 14%, you get to keep the full return. If the gains are above 15%, say 16% or 17%, you get only 15% because that's your cap. If the losses are up to 10%, so if the index falls 9% or 8%, investors are protected by that buffer and they lose nothing. If the losses exceed 10%, 12%, or 13%, then you lose that whatever comes after 10%. So if the losses are 11%, you lose 1%. The losses are 12%, then you lose 2%. And again, you can buy or sell whenever you want, but your outcomes would be slightly different. Now, let's go to the Zacks.com code page, and I wanted to show one of the most popular ETFs from Innovator Suite, which I mentioned. Innovator was the pioneer in this space, and they have a lot of ETFs, all sorts of indexes, all sorts of buffer, all sorts of caps, and there are many other variations too. So as you can understand, these are slightly complex products, so it is better to learn about them. You can use the link on Zacks.com code page and go to the web page, Innovators web page. They have a lot of resources, and I certainly encourage investors to read those resources and learn more about these ETFs. So this particular ETF is designed to buffer investors against the first 15% of losses over the outcome period. And so the remaining cap, okay, let's go to the fact sheet to understand it better. So the starting cap was 20.5%. Then exposure is to the S&P 500 index, SPY ETF, and the buffer is 15% in this case, and this particular ETF charges 79 basis points. Now, if you buy in between, then your outcome is going to be different, but the website provides details on what outcome you can expect if you buy or sell in between. Now, these rebalance after the outcome period, but can be held indefinitely. So when the outcome period ends in October 31st of October 2023, you will have a new cap, a new buffer, a new outcome. So it's better to understand what the new details are. Now, As I mentioned, they have a lot of resources, so please go through them, listen to their videos. And I wanted to quickly show some of other similar products from their suites. So they also have the buffer ETFs, power buffer ETFs, and also ultra buffer ETFs. These have different buffers. So there are ETFs which have buffer of 9%, so protection against the first 9% of the losses. In this case, protection would be against the first 15% of losses. This is slightly different. So the protection starts after the first 5% of losses. So if the index falls 5%, you will lose that 5%. Your protection is 30% from 5% to 35% of index losses. So that is why these are slightly complex products. It is better to understand what you are buying. Now, other things that investors should remember is that, again, that these protect investors only from a certain level of losses. So look at your buffer. Then buffer is only for a specific outcome period. You could still suffer losses over shorter period, and your market gains are capped. So if the market rallies a lot, you miss that upside. And also, since these gain exposure to the index through options, so you get no dividends. These ETFs are generally suitable for risk-averse investors because investors who want who want to be certain about their outcomes in the market, particularly investors who are nearing or in retirement. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer. Also, make sure to subscribe to all our videos, our video channel, so that you do not miss anything. And I'll see you next week.